Hello, my name is Adán Jiménez, and today my partner Dominic Brisson and I will be presenting Curtiss-Wright, ticker CW. Curtiss-Wright is an aerospace and defense company that manufactures highly engineered precision components and systems. Some of their products in their commercial, defense, and power lines are listed here. Essentially, they are motion control and surface technology products that increase the operational efficiency, safety, and ultimately the performance of machinery. Curtiss-Wright was founded in 1929 and has evolved tremendously decade by decade to remain an invaluable supplier for original equipment manufacturers and markets around the world. Recently, management has executed on a number of accretive acquisitions and rationalized operations in areas where prospects were low. In short, Curtiss-Wright has a team of astute executives that are quick to capitalize on opportunities. In 2019, the company had industry-leading margins of over 16%, and moving forward, the company has high and stable growth opportunities with the U.S. Department of Defense. This complemented by the macro recovery and the pandemic, which has severely disrupted financial markets and created an unreasonably steep discount in Curtiss-Wright, results in an excellent entry point to establish a position in a presumably long-term grower. Curtiss-Wright has a very extensive product mix. Therefore, we think it makes things much clearer to present sales broken down by end market. The left chart is sales by end market in 2019, which is broken down into aerospace defense, ground, and naval defense. That's primarily for the U.S. Air Force, Army, and Navy. And then there's the commercial aerospace, which is self-explanatory. The general industrial segment goes anywhere from automotive to agriculture to even medical. And power generation is primarily for nuclear power. As you can see, our projected sales by end market in 2023 highlight the quick expansion of the defense markets, primarily from the U.S. Department of Defense. And this is something that is key to our investment thesis, which we will highlight in the next slide. Presented here are the key drivers to our investment thesis. First, as they often say in sports, the best offense is a good defense. And for Curtiss-Wright, that means the stable long-term outlook stemming from the Department of Defense. They have strong demand in the Air Force for actuator components on the F-35 jets pictured here, which is described by them as the backbone of their inventory. In the naval segment, there's strong demand in the Columbia and Virginia submarines, as well as with the Ford aircraft carriers. Also, long-term prospects. The Columbia submarine, for example, is being developed to replace the Ohio-class submarine as the number one vehicle by 2030. Not only does the defense segment grow the top line, but it also carries operating margins that's on average 600 basis points higher than that of commercial and power products. Next, under the successful leadership of CEO David Adams, the company has effectively had a strong in-house cleanup. Their One Curtiss-Wright initiative launched for the rationalization, centralization of back office functions, and overall improvement of profitability has increased operating margins by 500 basis points in the last 6 years. Furthermore, the company exhibits strength in their ability to pivot with strategic initiatives. Most recently, with discontinuing their provision of actuators for the Boeing 737 MAX commercial airplane due to an anticipation of dilutive contracts in the future that comes from the pandemic's impact on the commercial airline industry at large. That being said, our final driver, Ride the Recovery, suggests that Curtiss-Wright will begin to benefit from the recovery in the world economy on their commercial and industrial segments, and we believe that this will continue to draw attention to the other growth prospects of the company and allow the market to realize the deep undervalue of the security. Presented here is a summary of our valuation for Curtiss-Wright. At the top is our peer group, which is a mix of aerospace and defense focused companies as well as general industrial conglomerates. Looking across the various metrics provided here, you can see that there are indeed lots of similarities with these peers and Curtiss-Wright. Curtiss-Wright tends to outperform nearly all of its peers across these various metrics and is yet trading at a discount resulting from extreme inefficiencies in the market this year. On the bottom left is a summary of our projections through 2023 and ultimately conducting a price to earnings, price to sales, relative valuations, and a discounted cash flow model. We arrive at our price target of $133.35, representing potential upside of 16.2%.
And now I would like to briefly touch on our risks. The first one, U.S. defense dependence. In 2019, roughly 38% of Curtiss-Wright's revenues came directly or indirectly from U.S. defense programs. As Curtiss-Wright continues to expand their defense offerings and it becomes an increasingly larger portion of the end market revenues, they will be dependent on U.S. defense spending. From our research, for the next 5 years, U.S. defense budgets are likely to remain steady between $700 to $750 billion. Now, for our next risk, nuclear power exposure. In 2019, 15.8% of Curtiss-Wright's revenues were generated from the commercial nuclear power industry. As the world adopts more clean energy solutions, Curtiss-Wright will be vulnerable if resistance to nuclear power as a source of clean energy occurs. In addition, the nuclear power industry outlook in the United States is negative, and according to IBIS World, revenues are expected to decrease at an annual rate of 0.9% through 2025. And lastly, for our final risk, acquisition integration. Curtiss-Wright has acquired 5 businesses for roughly $630 million since 2015 and utilized them to expand their end market exposure, largely in the defense and power generation segments. Recently, they acquired Packstar Communications for $400 million and paid 12 times EBITDA, which is higher than what they have traditionally paid historically for the past acquisitions. Accordingly, we modeled this business separately into our model and determined that it had a net neutral effect on our price target. However, we are optimistic that under Curtiss's leadership, Packstar may outperform their top-line revenue growth and be able to better rationalize their operating margin. And now I'd like to briefly touch on management. Their Chief Executive Officer, David Adams, began with Curtiss-Wright in 2000 and was appointed CEO in 2013. He brings 30-plus years of aerospace and defense sector experience and has, during his tenure as CEO, more than doubled their earnings per share and increased their operating margins by an impressive 500-plus basis points as of 2019. In addition, their Chief Financial Officer, Christopher Farkas, is a CPA and was appointed CFO in May of 2020 after their past Chief Financial Officer, Glenn Tynan, stepped down for personal reasons. Prior to assuming the role of CFO, Christopher Farkas was a corporate controller with Curtiss-Wright and was their VP of Finance. Prior to working for Curtiss-Wright, he held progressive accounting and finance leadership roles at Pratt & Whitney and Parker Hannifin.
In closing, Curtiss-Wright has been a success story for nearly a century because they continue to evolve their products and their strategies in approaching their various end markets. They have significant growth prospects, primarily driven by the Department of Defense. And we believe that the pandemic has resulted in a severe mispricing of this stock, which results in a great entry point for us to add this into our portfolio. Thank you.